Is the honeymoon over already? Let's talk about it. Hello everybody, Joe Warpick coming at you. And the post-election fervor in the stock market seems to have cooled a little bit, which is not a bad thing. Over the last 2 weeks, we've seen all three indices pull back. We saw the Dow pull back about 2%, the S&P pull back about 2%, the NASDAQ pull back about 3.5%. But since then, all three have recovered significantly. The Dow's about even, so we're seeing the Dow at its all-time high we saw post-election. The S&P still off about 0.5%, and the NASDAQ still down about 1.5%. So is the honeymoon over? I don't think so. Is the stock market poised for a massive pullback? I don't see anything that is looking like that could occur. In fact, while all three indices are at all-time highs, the S&P 500 PE ratio is down over 20% just from 4 years ago. And why is that? We've talked about this. Corporate profits are at an all-time high, and those corporations are able to charge more, and their cost of securing goods is lower. Their cost of their services in the form of workers is lower. And while they're receiving record profits, it does cost them a little bit more to do business, but not nearly as much as it did 4 years ago. And we're seeing corporate profits soar, which says if we're seeing markets at all-time highs, but corporate profits even higher than those all-time highs, that means the price to earnings ratio is going to be down, which tells you, the investor, there's a possibility that there's future gains in this stock market. Now, of course, that's not 100% guaranteed. Nothing is guaranteed anymore. But if we look at the demographics, we have about 180 million workers who are working hard and spending more money compared to the roughly 90 million who are retiring. That tells me we're going to see this market continue to grow. The only issue, the only problem I see is that Powell's bringing interest rates down. He's doing that to control and reduce inflation. And at the same time, his interest rate reductions are not affecting the 10-year rate in the proper manner. So we're actually seeing the 10-year hit a high since he began lowering interest rates. He lowered interest rates 50 basis points in October, 25 basis points in November, and the 10-year Treasury yield has risen to about 4.4%, which is causing mortgage rates to be around that 7 to 7.5%, and that's not allowing us to see that interest rate reduction that Powell has put into place pass through to the consumer yet. And the other issue we see is that 10-year rate, again, as I've mentioned before, is really dependent on economic conditions, and the economy is moving forward. We just had an election where they expect the economy to grow massively over the next 4 years, and there's going to be a struggle between Powell trying to lower interest rates and that 10-year surging up. And that is the only area that I see of concern that could cause not a recession, but make that soft landing a little bit more bumpy unless Powell's continued rate reductions eventually affect the 10-year. Make sure you check back for future updates because we want to follow this closely. I want to see the stock market grow very well over the next 5 to 10 years, but it's going to have a lot to do with what happens with Powell, with what happens with the 10-year, and with what happens with this economy moving forward, and something we want to keep our eye on. Trump is talking about lowering taxes, and I don't know if he'll be able to lower taxes lower than what they are, but he's talking about not allowing taxes to increase in 2026. That will be a big boom for everybody because that means that tax break we saw back in 2017, which freed up a few extra $100 to a few extra $1,000 a month for the average American to have to spend, would continue beyond 2025, and that would help this economy tremendously. If you like videos like this, make sure you subscribe, hit that like button, hit the notification bell to make sure you're notified every time I post. Leave a comment down below. And as always, I'll see you next time.